Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey, welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. Today, we are starting a new series where Josh and I will be discussing some current news and some things we're reading.
That's right. Reading? Wait a minute. Isn't that supposed to stop once you finish school?
You know, I can't. I was going to say I read and talk real good, but
you don't talk real good.
I don't talk real good, which is a funny thing as I make a podcast. But yeah, reading, writing, arithmetic. Contrary to popular belief, something that continues even after school, because as professionals, it's important to always read and have an understanding of the markets, industry, and current events. I mean, Warren Buffett's an example of this. He's 1,000 years old, and he still reads like 300 and some pages a day. Or whatever.
Read it
That's
all
he does. Yeah. You'd think there wouldn't be anything left.
When he had papyrus papers to read on, if he was that old. But we should make a disclaimer, though. This is our work-related reading for this episode. We may talk about things we're reading outside, but my Llama books I read with my kids, that does not count.
The Jesus Storybook Bible?
That's a good one.
That's a good one.
I will say my favorite book to read with the kids is Fox and Socks. It's a tongue twister book. If you ever want to be entertained, Google Fox and Socks fast reading. There's this young girl, I think she did for a talent show or something, but she read as fast as she could through Fox and Socks.
It's a real tongue twister. So yes, that is what we are talking about, is what we're reading, things that are going on right now. So each of us are going to talk briefly. We're not going to go into crazy detail, but briefly about 3 important things we're reading right now, and then we're going to discuss them. So Josh, why don't you start us off? What is one thing you're reading right now?
And these will all be linked in our show notes when it comes to the access to the articles. Some you may have to have a subscription for, but we will let you know where these ideas came from. All right, the first one is a proposal.
So it's really nothing.
It's not yet, but the proposal for one way of helping to offset the $3.5 trillion bill that they're working through in Congress is they want to offset some of that spending. And so there's been some articles written about some of those proposals on how they're going to do it, because most of those involve taxes. That's how you're going to offset the spending, is revenue collection taxes. And so everybody wants to know, hey, if my taxes are changing, what is it going to be? Can I do anything now to prepare for that? So one of the proposals is for billionaires having an annual appreciation tax.
Meaning we appreciate you, the billionaires.
Yes. And so what this is a annual tax on the appreciation or growth on their assets. And right now they're just targeting billionaires. They've been, again, this is all in proposal, so there's not a lot of fine details, but I want to talk about this higher concept and what this article notes. And this article, by the way, the one I'm referencing, there's a bunch out there because this has been a big topic, but Bloomberg is the one that had this article I'm referencing.
And by they, we're generally talking about the Democratic side of Congress, who is they maintain control of both houses of Congress. So this is legislation. The $3.5 trillion spending bill is their bill that they're pushing through as well, but it's their responsibility then to figure out how do we pay for this, and this is the answer to that question.
In fact, this proposal, though, is not new. It's been floated around by different senators through different, over the last decade or so.
And generally what it's called is a wealth tax. It's kind of what they're talking.
Let's see. During one of the debates, I'm trying to remember which one it was, but Senator Warren proposed this as where it became very well known.
This has been one of her kind of
big things, is a wealth tax. So this is kind of an offshoot of that. So the wealth tax was just an actual tax based on your income. If you earned a certain amount, they charged you an additional tax. This is really not looking at income at all. It's looking at assets. So it's similar, but a little bit of an offshoot to that. But it's saying, okay, if you have X amount in assets, billions of dollars, if you're a billionaire, what we're going to do is at the end of the year, we're going to assess a tax on your assets or on the growth of those assets. Right now, what this proposal is on the growth of those assets. And so normally you don't owe tax until you have realized a gain on an investment
It all goes back to income.
Yes.
That would be a form of income. If your asset appreciated and it's worth more than it was when you bought it, you had income on it.
Right.
And when you sold it, you did.
Yep.
And it'd be the same thing as if you were going to a job and you're earning income for your time.
Right.
They're both income-based, but this is a whole different side of the discussion on something that really hasn't been instituted before.
Yes. And the reason why is, when it comes to income, you have received something and they're taking a portion of that as a benefit for living here in the United States to cover all the things that they offer, the protection, security, all that stuff that they offer. That's where the tax is, right? The difference here, like you said, is at this point in time, you've not realized any income or any growth, return, gain, whatever word you want to use. It's been unrealized at this point. And so that's a big switch from how they've historically taxed. Now, in the article, there was a quote from President Biden, and he said, I support a lot of these proposals, which again, there's a lot of different tax proposals here. We don't need all the things, this is a quote, we don't need all the things I support to pay for this, but I do support that in reference to this billionaire tax. And continuing his quote, I just think that it's just paying your fair share for Lord's sake. That's his quote in the Bloomberg article. And so I know you and I have talked about this in the past, but fair share, I want it defined.
There's no number.
Please define it. Somebody say it's X amount.
Because he says fair share. Warren says fair share. And
it's an open-ended. You can keep saying that word.
And the other side of the aisle is they're asking the question, which is a good question. We just want clarity on what fair share is.
Yep. I
know
like
what fair share is.
Defined. I like to analyze something, and I need to know all the parameters within that, right? And so if that's an open-ended phrase, it's hard to know, well, okay, does this justify what you're trying to achieve?
Yeah.
And so that's just one of my frustrating pieces that just in general is when you use open concepts like that, it's hard.
Well, right, because we should clarify, is fair share a dollar amount target or is fair share a percentage target?
Yeah.
As long as you quantify it, we can at least start having discussions. But until there's actual numbers, it's really hard.
Yeah. I mean, you look at the tax brackets, right? If you earn this much income, you owe this much tax. That's what they've defined as the fair share of that. But that's been defined. And you can change it, right? You can change the tax code, which is fine. And then if they agree on it, then that's where it goes. Mm-hmm. But this is kind of an open-ended argument that frustrates me. But where that matters is, there's assets that are hard to value. If you have a stock at the close of any day, you know what that value is. Throughout the day it may fluctuate, but when the market's closed, it stops that value for that day, and then it opens the next day.
Yep.
That gives you a value. And so on 12/31, they can value those assets, and if they are charging this tax, they can say, here's your tax owed.
Yep.
The problem is there's also assets that don't have a daily value to it.
Right.
Property being a very easy one to understand. Yep. If you own a home, your home's value actually fluctuates daily throughout the day. Yep. But no one sees that because there isn't a stock ticker floating on the bottom that says your home's price or anything like that. It would be. But that's hard. So how do you value that? Is there a cost associated with at the end of the year, you have to hire an appraisal to come and appraise all your property?
Yeah.
What goes on there?
Business ownership.
Farmland. Business ownership. One. Yeah. There's a lot of assets that are a little bit harder to put a value on.
The less liquid the asset, the more difficulty you're going to have quantifying it.
And then speaking of less liquid, the other impact on this is, you're going to owe tax. So you're going to have to pay the government. Well, normally you sell your business. That's when the tax is owed.
Yeah.
Well, I have some money because I sold my business.
So pay the tax.
So I pay the tax with some of that money. If I still own the business, but I owe tax.
Where's the money coming from?
I think there could be some forced liquidation of assets to cover the tax on assets you weren't planning on selling.
And where's that going to come from?
Which will come from the most liquid,
which is going to be cash or stocks
or investments.
Right.
And so you're going to actually cause more volatility by forcing this, and then the volatility will cause price fluctuation, which will then cause people to buy or sell, which it could cause some problems.
I guess one of the worries that a lot of people are having is if this is a slippery slope, where does it go? So we're talking about billionaires now, and we're going to make them pay their fair share, which is air quotes because we don't know what the crap fair share means. And then, great, is that where it stops? Or at what point does the continued additional spending requirements cause us to trickle that down? That's the reverse trickle economic, right? Trickle down economics, where we're saying, okay, well now if you're $100 millionaire, we're going to do the same thing. Yeah. And now if you're a a 10 millionaire, and now if you are a 1 millionaire, where's it stop?
Yep. And then along with that, in the past, historically, income is what the IRS was using as a reference point. So if you think of this, the last COVID bills, they were based on income. If you earned under this amount of income, these are what you could get, right? This, because you can have billionaires earning zero income, right? And so that's sometimes how they skate by some of these tax codes is, well, my income's not very high. I just have all these assets.
Right.
Well, this one's bypassing income and looking at assets. And so you could have large farms, things like that you wouldn't normally associate, and I don't know if they're farmers necessarily billionaires, but depending on where this ends, you could have large family farms starting to get caught into these nets of saying, okay, now you owe us additional tax, and they're saying, well, it's all tied up in the land. I don't have that ability. So there's some issues there. That's what I'm reading, something I'm keeping an eye on. It's not finalized necessarily. It's going to have to be in there.
Yeah.
It's still all being negotiated.
And when that gets finalized and gets signed into law, we are planning on putting a dedicated episode for that bill and the payment
there'll be a lot to
requirements.
It. A couple hundred pages of the bill.
I'll have Josh read that in advance and give me the spark notes. What am I reading?
What
Number
are you
one.
reading?
So there's a keyword, a buzzword in the industry right now, or a phrase, ESG. Yes. So that stands for environmental, social, and governance. And we are, again, also
Egg,
going
sausage,
to do...
and gravy.
That is great.
That's a breakfast. ESG breakfast.
That's delicious. I would eat that right now, actually. We always record this when I'm hungry. Yeah. It just
You're
happens.
always hungry.
I'm
so.
always hungry. So we are going to have a dedicated ESG episode.
Yes, we are.
Very important theme that people are watching and talking about. But I was reading about this theme, and there's an author. He's really an NYU professor at the Stern School of Business at NYU. His name is Aswath Damodaran, and he's the evaluation guru of higher education and around the world. People look up to him a lot. He's a smart guy. The articles that he wrote that I was reading have like 23 million page views. Like,
Oh, wow.
pretty popular guy, right? He was just on CNBC.
Catching up to our podcast view.
He's almost there. If he keeps his foot on the gas, he probably will
If
get
he
there.
added a dad joke, he may catch us.
That's true. That's true. Because, valuation isn't known as being very funny. So anyway, he starts by saying, so this ESG in general is saying, you want a company that is run in a manner that is ethical and that is doing well for the planet and taking care of not only shareholders, but their employees and the good of society in general. Yep. That is like the 50,000-foot definition of ESG. Well, he is critiquing this discussion by saying goodness is difficult to measure because if you're investing in a company because it's quote-unquote good, what does that even mean? And how the heck do you measure that? How do you value that? So essentially, companies know what investors or fund managers are looking for to check those ESG boxes, and they can publish data or verbiage in their reports or whatever that checks those boxes without actually doing much or causing any change or any good. So it's really hard to quantify. That's a tough thing that he's pointing out. And he then points out that being, quote unquote, good will add value to some companies, but only some companies. Making changes desired in the ESG space will actually help their profits, their business, the people's view of the company, but others really aren't going to even be affected, despite spending lots of time and money on ESG initiatives that are actually going to hurt shareholder returns because the company could have gone and invested that to grow the company and then enhance shareholder returns. Some are actually just going to be unaffected. There's going to be a wash where they're spending money and it is going to do some good, but is it going to offset
what they could have done?
So
along with that, and I know you and I have looked at this before, what you talked about is hard to define good. Well, not only is it hard to define it, but people have different scales where they'll say this company's good, and then the next person say that company's okay, and another one says no, that company's bad. And so while ESG has some standards kind of across the industry, when it comes to investors themselves valuing it, like you said, there's all these different standards.
There's a spectrum of ESG, and it can go from very, very stringent, where people will exclude companies in the alcohol and gambling industries, things that are involved with pornography, things that are involved with marijuana would be one, weapons, that would be one, all the way to very specific religious other groups. So Jewish or Muslim groups have different codes of different requirements as well. So it's a broad term that isn't really well defined, and I think that a lot of investors are kind of I don't really want to say duped, but I'm going to say it. They're duped into putting money into an ESG fund to think they're doing a good thing.
Yep.
Even though essentially it's like outsourcing their conscience. Mm-hmm. Like you're putting you want to feel good about investing your money in an ethical way, but you're not putting in the time or the effort to know what that really is. You just want to check a box there. Yeah. He also mentions that the ESG sales pitch to investors is completely inconsistent and fundamentally incoherent. Basically, what's good to some people isn't good to others. That was one thing you pointed out. Yep. His quote, he calls ESG, quote, a flawed concept, and perhaps fatally so. And I'll end the quote there, because it all depends on who it benefits. So companies aren't going to do things from the goodness of their heart. Publicly traded companies. They will only do it if it helps their perception, which is then going to help turn profits into stock price. Yep. So that's kind of how that works. My thoughts are, if people pile into ESG favored companies, the companies that everyone thinks are doing the right thing on an ESG basis, these stocks are going to go up for a period because, if there's more buyers than sellers, stocks go up. But eventually, if you're not investing companies that are doing the right things fundamentally, on their financials, then you're just going to increase the valuation and cause volatility again and corrections because the price had gone up further than the fundamentals had, just because on paper it sounded like a good ESG play. So my advice, do your own research. That's probably the best way.
Good advice in general. Good. So my next article I'm reading is exciting news. And Austin, I know you are a fan of TikTok.
I am.
Yes, you can.
TikTok gets a lot of hate.
It does, and we'll talk a little bit about that.
Okay, good, because I have some thoughts.
Yeah, but it passed 1 billion monthly users.
Yeah, monthly active users. Yep,
monthly active users. Yep, and which is a big deal because they launched in 2018.
It's pretty new.
That's pretty new compared. I mean, their growth chart has been pretty impressive, and despite some government pushbacks, especially here in the United States, it has not only maintained its growth, but it has become very popular.
Yeah, I was a late adopter, so
yeah, so. TikTok is a app that you have on your phone.
Social media.
It's social media. It's designed for short video clips, usually accompanied with music, but they're not long videos.
They did increase the limit. It used to be really short. Now it's up to 3 minutes.
Yeah, but you think 3 minutes compared to like YouTube.
You get hours.
You could have hours on there. So they're designed for short, digestible clips there in TikTok. Now, with this success comes competition. So Instagram launched theirs. It's called Reels, I believe. Yep. YouTube has YouTube Shorts. Mm-hmm. And then Snapchat.
As opposed to Pants.
Yeah, I guess. Only in the summer. You can only do it in the summer.
That's right.
And then Snapchat has their version, which I'm not sure exactly what that one's called. But they all launched competing apps because they saw this popularity. Yep. Despite that, it continues to grow. So TikTok users, this was a different research they did just recently. TikTok users spend more time watching than YouTube users do.
Wow.
Which again, going back to length, that means they're watching a lot more clips than a YouTube user, because he or she may watch one clip and it's 30 minutes long. Well, that's 10 different YouTube clips if you had the whole 3 minutes used in. So that's just crazy to think. A couple pieces of stats. So in 2020, most recent full year, they had revenue of $32.3 billion, which was almost double from the 2019 revenue. So again, as they're growing, they're really seeing that. They've had a total of 3.2 billion downloads.
That's half the world's population.
Is it?
6 billion people.
Oh, man.
6 or 7, yeah.
Yeah. So
that's a lot.
I guess you could have maybe
more
download
devices,
more than once
still,
if you needed to.
That's a lot.
That's a lot of people. And then I saw this. I was not aware of this. But to talk about the platform and kind of that connectiveness, they actually had a full musical they put together called Ratatouille, the musical, the TikTok musical. And what it was a bunch of users combined together their little clips, and they pretty much did a Broadway musical of the cartoon movie awesome. Ratatouille, which is hilarious. But they had a one-night showing of this where people could log in and view this. And it raised over $1 million, and all that money went to the Actors Fund, which was to support workers in the industry that were out of work because of COVID and stuff. But it was just a really interesting thing.
Yeah, you got to watch those multimillionaire actors.
There's a lot of supplemental jobs that are all in there, but you're right. There's probably a very
Daniel Craig gets a stipend.
So that was just interesting to me when I saw that.
Yeah.
But here's some stats. So again, they launched in 2018. January of 2018, they had 55 million global users. Okay, 55 million.
Yeah,
that number grew more than 271 million in 2018.
In a year, it quadrupled.
And then 507 at the end of 2019.
Doubled again.
And then it doubled there because, we're midway through 2021, but then we hit 700 million
in 2020.
Active users last year in 2020. And then from there, we're at 1 billion.
Wow.
So, and you can see that growth rate. Now, let's put that in perspective, okay? Facebook at the second quarter of this year had 3.5 billion monthly users.
3.5 times as big.
Yeah. So
people-wise.
Still in comparison, but this is one app. Facebook has Instagram. It has Facebook, the main app, and they own, I don't know what else they own.
The chat.
The Facebook Messenger.
WhatsApp.
Yep. And so this is just TikTok, but they're still 3.5 times smaller.
So TikTok has, especially in the U.S., faced a lot of scrutiny. I'm going to take national security concerns aside because that a lot of people can kind of try and understand that because a Chinese company put together the algorithm for all this. That makes, we can get behind that.
Yep.
That was the issue, part one. But now, just like a lot of social media, TikTok's getting a lot of hate for how much time people spend on it and how easily it is. I know that specifically in like faith-related circles, it's not a favored social media platform because of how quickly swiping through videos can get to something inappropriate.
Yeah.
I found a solution for this.
Yes.
And I attest
it's your
to
likes.
This. I think the algorithm really goes by, maybe how fast you swipe to a different video and how quickly you like it or follow the channel or whatever. I only watch food videos and cute dog videos.
Yep.
And I only see food and cute dog videos. It knows to only show me those. So if you only just take my advice.
You start adding in dad joke videos.
There are good ones. Raina sends me dad joke videos on TikTok. So my solution to seeing bad things on TikTok is to only watch food and dogs.
There you go.
It's pretty good.
Can't go wrong there.
So anyway, that's good.
You mentioned that. So a couple years ago as they were starting, the worry was it's a Chinese app. It's a Chinese company. It's developed there. The algorithms there. All the data goes to there. So, that user's data gets transported over there. So the worry was what kind of information is this Chinese company getting in probably the government because of how they run things over there in China. And so there was an instant where they were going to be bought or needed to be bought by a U.S. company or at least have a majority stake in order to continue to be used here in the U.S. That was under President
Oracle
Trump.
Was on the hook for
Oracle was going to do that. And then when President Biden was elected, that kind of got pushed to the side, and now I think Oracle has said indefinitely is kind of on the back burner. It's not happening. And so it's not the only tech company that's in China. It's not the only one. They were actually going to go public as well, and that's been kind of put on hold.
China's put the kibosh on public anything.
Nope. Yeah. So there's been some issues there, but they continue to grow. And it's, again, the other, like you mentioned, the other concern too is for that younger generation, some of that impact, there's issues of bullying, things like that online. Is this being a contributor to that? So
online bullying?
Yes.
Like
not bowling like with a ball and pins, but like being bullied.
Oh, that's a little different.
Yes. So
like you're the
but
pin.
That's something that, for a company that's only a couple years old to have 1 billion monthly active users.
It's a big number.
It is.
Billion with a B. So Josh, we've talked about half of our things that we've been reading.
Half.
I think I need to lighten the mood a little bit.
Okay.
Give me a dad joke.
All right.
My weekly dose.
The unemployment rate is pretty high right now.
It's 5.2-ish.
It's pretty high. And so when you're looking at bringing on employees, you want those that, have a lot to offer your company, right?
This is just a fact.
I'm just telling you right now.
Are you going to a joke?
I'm setting this up because you got to understand. So when you're looking to hire, one of the best people to hire are waiters. I don't know if you knew this.
Yeah.
Because they bring a lot to the table.
They bring a lot to the table, but
that's it. There's a lot to set that up, but I need it
thank you.
Just for fun.
You had to tie it into current events.
Yes.
You had to tie it into current events. All right, what is Austin reading number 2? There's a lot of China. We're talking about China a lot. We talked about it with TikTok. I'm going to talk about it with crypto.
All right.
Because China has, I'm going to use it again. China has put the kibosh on crypto. They said, crypto, no mo.
Yes, we're done with it.
On Friday, 9/24, the People's Bank of China, the PBOC, announced that all, keyword there.
Is it really the People's Bank?
Right.
Really the
People's, as in the government's Bank of China. They announced that all crypto-related activities in China are illegal. All.
And they probably gave everybody enough time to liquidate.
Oh, I'm sure. In an efficient, orderly fashion.
Sure
yep.
they did.
So that would mean trading, order matching, issuing of tokens and derivatives, mining, NFTs, all illegal.
NFTs.
NFT is going on. Actually, that's an episode we did a long time ago.
We did. That's a fun one.
Non-fungible tokens. Check it out. We'll link that in the show notes. But, yes, all of those things are now illegal in China. That sounds dramatic. It's illegal. There's $2 trillion in market cap in crypto around the world, and 1 billion people in China. They can't use crypto.
Yep.
So how dramatic is this really? Well, it caused a 5 to 10% crypto sell-off after the news broke, which in the grand scheme of things for crypto isn't that big.
5-10% drop in crypto, is that a big deal?
Right, exactly. It's like it's volatile or something. But the impact is rather limited. This is the 20th, yes really, 20th time that Bitcoin specifically has been banned in China. 20th.
Did they unban it and then reban it? Or
I think they just keep banning it.
And it doesn't stop.
And it doesn't stop it because can you turn off the internet is really... If you can have...
They can, I think, actually.
If you can have the internet, you can have cryptocurrencies at this point. So, yes... That is why. So CNBC's Meltem Demirors, I think is his name. I don't know. Sorry if you're listening and I mispronounced your name. But his quote from an article on CNBC, we'll link below. There's always something different about the bans, but this happens all the time, and it's never really dramatic in the larger scheme of things.
In other words.
Because if they did it 19 other times, how is this time really that much different?
Yep.
But the real question, Josh, is why?
Why?
Why the heck would China do this? It's innovation. This is great technology. This is a good thing. One of the bull cases of it is that it puts the power in people's hands financially, right?
Now, I know you have reasons why.
Yeah.
I have a reason why.
Tell me why.
They are preempting their launch of China Coin, which is a new...
I'm getting there, Josh.
Okay, good.
Stop.
I didn't see you had that on there on their list.
Well, it all goes back to control.
It is.
That's
why. Really what it is.
So if Chinese people specifically are using or exchanging their RMB, that's their currency, the Chinese government has some control over how much that's worth and what it's used for, right?
And they can keep it in country.
They can, or whatever they want, they can control where it goes, even if it goes outside the country. And if they use the newly issued, here's where I'm going there, digital RMB.
Oh, they have one.
They do. It's already there.
I did not know that.
They have even more transparency and control because if they have an internet connection, they could take all your money tomorrow.
It's theirs.
It's theirs, really. So it's really all about control. And with decentralized currencies, as cryptocurrencies are, they have little to no control, and that makes them scared. It makes them uncomfortable because the Chinese government is communist. They want to control every facet of everyone's life.
Yep.
And they also don't want people to become wealthy.
Want them to rely on the government.
Exactly. So that is why...
I just thought they were just going to have China Coin and say, hey, Dogecoin's out. China
Coin in. To the moon.
Yes.
To the moon. So we should also put this in the U.S. perspective here because that's where we're sitting here. So what should U.S. crypto investors, or some would say speculators, what should they think about this? Well, number one, really it's more caution not about what China's doing, but it's what about the U.S. regulation could do. Because on the table now is crypto regulation. We don't know what that's going to look like exactly or when, but SEC Chair Gary Gensler, Janet Yellen, the Treasury Secretary, and Jerome Powell, the Fed Chair, have all talked about many times and are looking into what regulation in the crypto space is going to look like. Not if it's going to happen.
Yeah, it's happening.
It's what it is going to look like when it happens. We don't know what that looks like, but many U.S. crypto advocates actually think this is a net bullish thing because some regulation will make the technology in the crypto space more palatable, more appealing to a broader investor base.
Yeah, there's a lot of people waiting to say, okay, let's get some regulation in here, and maybe we will then step in.
The ability that's coming up to eventually invest in crypto ETFs and things like that will also make things a little easier for people with traditional brokerage accounts. That's one facet. It could limit, one of the downsides is that things like regulation usually limit crazy upside. So Bitcoin maybe not be able to jump 20% in a day.
Maybe just halfway to the moon.
Maybe just halfway to the moon if you've got this more regulated, more stable and safe market environment. So that's kind of where we are as far as China cracking down on crypto. Josh, what are you reading
Number 3.
in your third article?
My third and final article
For
today.
the last one you'll ever read.
This is it. I'm done.
Until next episode.
It was actually an article on CNBC, but they had an article, and there was
Canadian News Broadcasting Company.
I don't know what it stands for.
It's Comcast something.
Comcast.
Yeah.
They had an article, and it was talking about just the recent dip we've seen in the stock market the last couple of years. They found that there was actually, when they did a poll and did some research, there was a pattern or a kind of a group of people that were more likely to be the ones participating in the selling of stocks during market dips.
That would be dogs.
That would be Doges.
Doges. Yes.
No. Now you've seen this article, so you already know the answer. But if you were to think through, okay, who's the most likely people, this is not who I would have picked, actually.
Right. I would have said young, inexperienced investors.
Yep.
That's really what
new investors, new investors. That's where I would have landed. But it's actually the highest probability of people selling when the market goes down are married men with children.
Yep.
Typically over the age of 45.
Okay.
So that's pretty descriptive.
So
right
these
there.
people may be experienced investors.
Yes. So in fact, here's the quote. Men over age 45 who are married with children and have self-described excellent investment experience are more prone to sell-offs.
See, that is counterintuitive to me because if you're 45, you have 20 years probably of investment experience and you've been through at least probably two bear markets. Mm-hmm. So my thought is that you would have been panic buying.
You would think.
Nope.
And they are even self-described excellent investment experience. So it's not even you're assuming that. They're actually describing themselves as having
Well, don't we all describe ourselves more favorably than
the average?
Yeah.
I like to
You have average investment
I like
experience.
to outperform but, under deliver. How do you say that?
Under promise and over deliver?
Yes, that's the word
Okay.
I'm looking for to put into my mouth and then spit out. That's it right there. So that's interesting.
Yeah.
They also found women are not as likely to take huge decisive action. They think this is because they're not quite sure that their impulse or their feelings are correct in that situation. In other words, they're not so overconfident in their ability to do that.
Yeah.
They're willing to wait or seek somebody else's advice.
Which really works in their favor.
Which is to their advantage.
Yeah.
Yes. Another reason why women are way better than men.
I was just thinking they're so much smarter.
It is. Yep. Men are 35% more likely to trade investments than women are.
So actually do the trading
that was from Fidelity who did that study.
Yep.
And trying to time the market often leads to lower performance, which we all know. And so it tends to be, and they had a couple in the article talking through about why male figures necessarily when they're younger age are prone to feel pressure to figure it out themselves or the idea that they need to solve the problem.
Right.
And so that triggers what they describe as a control bias. In other words, I have influence on this. I'm the one that needs to make the decision. I'm the one that has the biggest impact. And so this control bias then leads them to think that they're the ones have to make the decision.
I just feel like these people, this is everyone.
Yes.
But people need to live. Warren Buffett's no dummy.
Yeah.
He got to become a billionaire.
Because he's 1,000 years old, right?
Because he's 1,000 years old and he's seen a lot of crap. And if everyone would live by the be greedy,
drink Coke, eat McDonald's every day.
Yeah. Be greedy when others are fearful and be fearful when everyone is greedy. That mantra, this would be not a problem.
Yep.
And so really, that leads to my panic buying joke.
Yes. Well, and it leads to this. If you know you are the type of person or have the personality to have those reactions, your best option is to put in checks and balances. Mm-hmm. One of the best ones is
work
to have
for the
a
government.
financial work. No,
that's checks and balances.
Checks and balances. But this is have a check and balance in your stopping you from making a decision.
Yes.
Have a financial advisor. Have someone you trust that you can talk with and say, hey, here's what I'm thinking. Here's what I'm feeling. Have them work it through with you.
Yep.
To me, it makes a lot of sense. It tends to be that you're adding one more layer to remove that emotion from causing that decision.
Right.
We always say you want to avoid those big mistakes, and the biggest mistake you can make is selling and getting out of the market while it's down and eliminating all chances of recovering. Because when you sell and take out of the market, there's really no chance of recovering at that point.
So what's the Nick Murrayism that I'm thinking? When do you buy stocks?
When you have money.
When do you sell stocks?
When you need money.
And what else? What's the rest?
You hold it.
The rest is market timing if you do anything else.
Yes.
So don't try and time the market.
Yep.
Invest periodically is what we would say.
Yep.
Consistently
Put money
and
in.
set it automatic.
Yep.
You'll never have to worry about these things. But also, go ladies.
Yeah.
You got
and really,
your stuff
risk
together.
tolerance is key, too, is understanding how much risk you can tolerate and not taking excess risk. So, interesting article.
Yeah.
Again, it was not the people I would have thought, but, it is what it is.
Maybe it's because all the young people have been trading Dogecoin.
That might be it.
And they're used to drop
volatility
20% in a day or whatever.
Yeah.
So what's Austin reading number 3?
Last one.
It's another story about China. So that's kind of the theme of
Do you get like a Chinese magazine?
I must. So there was a good explanation of the China Evergrande situation in the Bespoke report recently, and unfortunately, this is going to be a paid subscription, so you probably won't be able to find it. But I got some good information from it. So here's the explanation at a high level. So Evergrande is one of the world's largest property developers. Mm-hmm. It's big. It's a big company.
Yeah, it's grand.
It's Evergrande. Yeah. And it's a Chinese company. Mm-hmm. So let's just put that lens on here. And China has been expanding their real estate development footprint at 100 mile an hour for decades now. So much so that there are actually ghost towns of unused built real estate.
Yeah, there's like whole cities
ready to move in, but nothing there. Exactly. Crazy. So, as is the case with most real estate developers, the company has used debt to fund the vast majority of its operations for a long, long time, especially as global yields have been really low, making their borrowing costs really low. So, Evergrande has accumulated debt of around $300 billion, which may or may not sound like a lot, but when you consider that the company only has a market cap of around $34 billion, that's 10 times.
Wow, yeah.
And that's due to a sharp sell-off, so still.
I don't think they sold off $300 billion, though.
No. Yeah. It's huge. It's a huge debt load for the company. So the Chinese economic growth and their recovery from COVID, it's slowed down, as has a lot of the world. And the Chinese government has crimped down on innovation, like we talked about with crypto, and any thoughts of a free market, they are kind of really putting the kibosh on. I'm using it again.
Oh, man.
It's that kibosh. So the company got into a pinch. And that pinch led to them to begin to having troubles paying their interest payments lately. Most notably, some 2022 dollar-denominated bonds, although most of their debt is denominated in onshore RMB, they got into a pinch and were not able to pay their 2022 US dollar-denominated bonds. That's not good. When you default, that's a default. When you're unable to make your payment, that's very bad for the way the world views your company, and that has caused their stock price to go bad. It's also bad for the bondholders. Mm-hmm. Now, every bondholder knows they're taking some risk when they buy a bond.
Yep.
That's why you have debt ratings. Yes, exactly. But overall, not a good deal. Not a good deal at all. So why does this matter? Well, many people think this is like Lehman Brothers 2.0, 07, 08, and that the Chinese financial system is about to fall apart due to over-leveraging. The good news is that this current situation with Evergrande seems pretty well contained to this one company at this point. And, it doesn't seem to be a systematic problem. The bad news is that this news sent further shocks through emerging markets in general, which China is the largest component of. Emerging market stocks have already been doing pretty poorly. This also could be viewed as a buying opportunity. It's not a recommendation, but emerging market stocks have tanked because of this. Yep. So that's why it matters, because we would recommend most investors to have a balanced allocation, globally diversified. It's good to have some emerging market exposure. It's good to have some developed international market exposure. It's good to have some U.S. stock exposure. But this would have been a drag on the emerging market exposure specifically there. Yep. So that's kind of what's been going on at a really high level with Evergrande. And despite it sounding like a Spanish company, Evergrande, it's Chinese.
Interesting.
Chinese News 3.0.
That's a China real estate fund.
It's a real estate fund.
Okay. So interesting. And you mentioned the Lehman Brothers. What you're referencing there was during the global financial crisis, they also were having trouble with their debt. They had bundled certain things, and their debt load was just too heavy for them to manage. So, which caused a ripple effect and caused a lot of issues throughout our economy. But
exactly.
There was underlying issues there anyways. That doesn't appear to be the same with China.
But also, we have to put a Band-Aid on and say that the Chinese government could do whatever they want with this company. They could write off the debt and fix it all tomorrow, pay the debtors.
I saw a nice theory that said that they were going to have convert the debt to Bitcoin and then ban Bitcoin, and then their debt was gone because they couldn't trade it anymore. So maybe that was this whole plan.
Okay.
Maybe your two articles are more
They're
connected
tied
than you
together.
think.
It's the same.
You'll find out that they just eliminated all their Bitcoin debt.
Well, everyone, this is a new format that we're going to try once in a while. I think it's a change up. Just kind of shows some current events that we're thinking about, and maybe you're hearing about and reading about as well. And hopefully, we were able to put a little bit of a light spin on some of these thoughts and explain it a little bit. So hopefully you like this. Let us know if you did. We're always open to feedback. So email us at hello@theinvesteddads.com if you have any feedback about this type of episode. 2 things from me. Number 1, it's not too late to enter our second half stock draft competition. And you can really enter all the way through the end of the year.
Yes.
And you might be beating some people at that point. Who knows? You get a fresh $100,000.
Yes.
Of fake dollars.
Not real money.
You could buy Evergrande.
You really can you?
Yeah, it's Chinese. You can buy Chinese traded stocks, I think.
Okay.
I don't think it's just US stocks.
All right.
I'm not 100% sure on that.
Sure.
So anyway, that's number 1. Number 2, as always, check our free gift to you. It's a brief list of 8 principles of timeless investing. Overarching investment themes meant to keep you on track to meet your long-term goals. It's free on our website. Josh, how can people help us grow this podcast?
Yep, make sure you subscribe. That way every Thursday you get our newest episode. And leave us a review on Apple Podcasts. That helps us rate and rank, so hopefully we can reach more people and help more people. Like Austin said, if you have any thoughts about this, the way we did this with our articles, shoot us an email at hello@theinvesteddads.com. Or if you have a subject or topic you'd like us to talk about, we'd always love talking about those. And if you know somebody who reads articles, make sure you share this. See, I knew he was taking a drink right when I said that.
If you know someone who reads articles.
Share this episode with them.
Right.
But if one of these topics was interesting, somebody was talking about it, do share it with them. And that's all I got.
Yeah, until next Thursday, have a great week.
All right, talk to you later.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.